Well, we wrapped up this past week muddled in the red just after Jerome Powell reiterated the Federal Reserve's rather hawkish stance here on top of an initial jobless claims report that depicted that the labor market was in fact still strong. All of which I'm going to go ahead and unpack for you just so you can get a good understanding of what's going on here. Then we're going to get into what's coming up this upcoming week, and I'll deliver through on 7 dividend stock opportunities that are worth your attention right now, and depending on the makeup of your portfolio, your investment. With that, let's dive right in. So it's safe to say that the market has been on the fritz as of late, as it ebbs and flows into green days and then back into red days. However, this past week was particularly interesting, at least in my opinion, for all of us investors. You see, while it was a rather lighter week on major economic reports, on Thursday, Federal Reserve Chair Powell spoke out to brief us on the Federal Reserve's policy stance. Nothing too new was said, though you would think that he shared a world of a difference worth of news based on how the market reacted. Nonetheless, Powell essentially shared that the Open Markets Committee is committed to achieving a monetary policy that is sufficiently restrictive to bring inflation down to 2%. And then he followed up that statement by sharing that the central bank is not so confident that they've actually done enough in this battle against inflation. So in other words, Powell alluded to more aggression to come, which again, for all of you who have been avidly following my channel, is not new news. So I hope it didn't shock you as an investor. Then we also had an initial jobless claims report that came out on Thursday that depicted that state unemployment benefits fell by 3,000 to a seasonally adjusted 217,000 for the week. Now, economists forecasted 218,000 claims which would come in, and that was just about on the money, but all ultimately signaling here that layoffs remain low, even as the still strong job market shows some signs of cooling. Hence why Powell actually alluded to the central bank's lower level of confidence that they didn't do enough. Now, upcoming this week, Tuesday, we have the next CPI report, which, if it depicts inflation inching upward, will only deliver another blow to the market participants, because our reality is that the economic situation could get much worse before it gets better. But I'm only now going to share this. We all should be gearing up for buying opportunities, shopping for high-quality companies that are discounted, which leads me to the very first dividend stock on our list today, a multinational food processing company, Archer Daniel Midland, ticker symbol ADM. Now, Archer Daniels is engaged in the procurement, transportation, storage, and the selling of commodities and various ingredients worldwide. So perhaps one of those dividend gems that you wouldn't hardly think about on a day-to-day basis. However, it certainly makes for a powerhouse in its own right. But in knowing that the struggle in regards to our macros is real, we of course have Archer Daniels down on the year by 18%, trading for just $72 per share at a low PE ratio coming in at just 10. But now I want you to think longer term when it comes to Archer Daniels, because if we look at the past decade, Archer Daniels has soared by over 131%. So while it may not be your SoFi or SPAC gut-wrenching type of gamble in the market, it delivers. And analysts continue to forecast upside, about 28% worth of it, projecting a share price to climb back up to $92.75 per share. However, we are of course here for the Archer Daniels dividend coming in at 2.5%, yet steadily growing by 5.72% over the last 5 years, with a 29-year track record worth of dividend growth. As for our second dividend stock of the day, we have Cisco, ticker symbol SYY. No, I'm not talking about the tech giant, but rather the Texas-based food and tablewares distributor, which is down right now by 9.3% year to date, with a PE ratio coming in below 20 at 18.9. And this makes for an interesting investment, considering that Cisco also wavers depending on supply and demand shifts related to dining out demands that are only likely to return, which will ensure that Cisco continues its wave of success, adding to their 163% appreciation track record over the past 10 years. But now, let's get to the analysts here who are forecasting only upside. $80.88 is the forecasted share price. That makes for 21.22% worth of upside, as smart money snags nearly 1 million shares up last quarter, which is all exciting news. But here is where the passivity of investing into Cisco really kicks in. Cisco has been shelling out and growing its dividend now for 8 years at a growth rate of 6.58% over the last 5 years, with a current dividend yield at 2.98%. Now, Now, investors, just before I get to these next 5 dividend stocks, the most important thing that you could do as a viewer out there is take one moment to tap on that thumbs up button, because believe it or not, I actually gauge whether or not content like this is helpful for all of you as investors. Now, I can only know if it's of value to you if you tap on that thumbs up button. If so, and I get a lot of likes, I just continue to make content just like this. With that, I'm going to get back to it here with the iconic soft drink manufacturer and salty snack player Pepsi, ticker symbol PEP, which is actually down, believe it or not, nominally on the year by almost 5%, trading for $167 per share, a PE ratio of 27.9, which then begs the question, why am I even bringing Pepsi up? And my answer is pretty simple. An investment like Pepsi is never really going to reach the low lows of some of our other dividend stock mentions, so it's all really based on the nature of reliability in Pepsi. Therefore, you're only ever really going to pay close to or at fair price for it, and I personally don't have any issues with that as an investor and using that as a plan of attack, given an investment into Pepsi always delivers. A matter of fact, over the last 10 years, it rose by 160+%. Now, with the economy as is right now, it may very well be a refreshing add to your portfolio, especially with smart money adding more shares to their portfolios and scoring big with over 4.1 million shares worth of Pepsi last quarter, not to mention analysts forecasting 11.7% worth of upside, coming to a share price of $186.71 per share. But its beverages and snacks aren't necessarily what sells me on Pepsi. For me, it's all about the dividend, coming in at a 3.02% yield that has been growing by 6.87% over the last 5 years, and doing so while passing king status with over 50 years worth of dividend growth. Next up, a dividend stock that perhaps flies under the radar for all of us dividend investors. At least it certainly does for me, but it is an opportunity right from my childhood stomping grounds in New Jersey. It's New Jersey Resources, ticker symbol NJR, which is in the business of providing safe and reliable natural gas and clean energy services across the state through various segments, whether it's through transportation or right to residential living. Now, as we speak, New Jersey Resources is down by 13%, trading for only $41 per share, as many energy and utility plays are actually right now down. But New Jersey Resources here is at a rather low PE ratio of 14.3, and even more exciting for all of us to understand is a strong track record worth of growth, 153% of appreciation over the last decade. Now, what's even more interesting here when it comes to New Jersey Resources is for such a small player, it has a lot of hedge fund attention. We do see plenty of hedge funds snagging more shares of New Jersey Resources, and then we have over 27 years worth of dividend growth at a 7.45% growth rate and a solid 4.06% dividend yield to benefit from. But if New Jersey Resources didn't quite arouse your investment appetite, if you will, I am positive that McDonald's, ticker symbol MCD, will, because this golden nugget opportunity is only trading for $266 per share right now, which may not seem like a lot, but that's actually down by about 9% over the last 6 months, with a relatively low PE ratio here for McDonald's at 23.7. But what I love about McDonald's is, at face value, the company is of course your run-of-the-mill fast food company, but when you really get into the golden nuggets of what this opportunity presents, it's a real estate empire. Now, we're talking about a powerful money printing machine, and we see that is still the case here with McDonald's over decades and decades, with appreciation of over 257% over the past 10 years. Now, that is likely because a $1 menu burger or Big Mac won't ever go out of style, but it's really that real estate empire that allows them to grow. For 16+% worth of appreciation expected by analysts, now coming up to a share price of $310.42 per share, with hedge funds loading up on McDonald's as well. Yet what makes McDonald's really a standout investment for a dividend investor like myself is the dividend insights here, whereas we have McDonald's with over 21 years worth of growing dividends at an 8.52% growth rate, currently coming in at a yield of 2.5%. Next up, let's talk about another insanely reliable dividend kingpin here with American States Water, ticker symbol AWR, which produces, distributes, and sells water, which has been in contract now with the US government for over 50 years, and that's just some added security for you as an investor. But by no means does that mean that the company doesn't waver for now in market uncertainty, because as of this recording, American Water is actually down here, trading for $77 per share. That's over 16% worth of a decline year to date, with a P/E ratio at 24.9. But now have a look in a review here of the track record depicting over 236% worth of appreciation. So here's the next decade to come, and this is all really exciting me because we're even seeing insiders right now who are mounting bets, building up their positions with American States Water. And as for you, the shareholder, well, it's a thirst-quenching dividend yield year at 2.19%. It's been growing by 9.3% over the last 5 years, with a beautiful 67-year history. Now, this next dividend stock has been all of the craze as of late, and it's just way too hard to ignore right now, given it's steeply discounted. It has a solid dividend history, and its ability to jack up its dividend is just very impressive. We have Air Products and Chemical, ticker symbol APD, which is a provider of atmospheric gases that also manufactures equipment for air separation, hydrocarbon recovery, and purification. Now, in other words, we're talking about really the reality of mad science when it comes to Air Products and Chemical. But this gold find recently just plummeted to $261 per share, which is 13% down now year to date. And as we can see, just after a recent free fall this past week, the buy alarm certainly was sounded by none other than the chairman and president himself, scoring more than $2.5 million worth of the stock. And as for analysts, they only foresee upside coming back Air Product and Chemicals way. This one has over 21% worth of upside forecasted to a share price of $317.17 per share. But I would encourage all of you investors to hold tight with a play like this one, because it's delivered through on 230+% worth of appreciation over the last decade. Now, we also get to enjoy a lot of dividend income, at least for 40 years, with a 10.08% growth rate over the last 5 years, and it has a current dividend yield year of 2.69%. But now I have to know, investors, what your thoughts are on these dividend stocks, if you own them, if you're thinking about now buying them, or if anything here, let me know if you have better dividend stocks in mind. Comment down below to let me know. If you found this video to be insightful, I can guarantee you're going to love this one right here. Give it a click, but before you do, make sure you're subscribed to never miss a single dividend stock idea.